Can Mr. and Mrs. M retire and travel? They want to travel a lot. They're going to spend a lot of money on travel. So let's dive into this. It'll be interesting to see. And so this is set up from a guy who said I could use his info. He actually paid me a pretty good amount of money to do this. I'm not going to have a formal financial planning discussion with him, but he goes, man, I'll pay you money. You can do it just, obviously you can do it for a video, just don't use my info too. But I said, no, I'd be happy to do that. I thought it'd be pretty interesting. So let's dive into this. I haven't done anything at this stage. He sent me a couple emails with questions that he's thinking about. Is it discretionary income too much? And we'll go over to it. But so let's take a look here. So I haven't done anything at this stage other than say, yeah, man, if you want to pay me and have me do a video, and I'll be happy to. And he said, you can share it with your audience too. So that'd be great. All right. So in this case, we got Mr. and Mrs. M, 1.85 million in net worth. Let's just take a look at the details here. He's got an IRA, 1.4 million his own IRA. He's got a house, 875, and they got a mortgage, 425. Okay, gotcha. All right, good. They live in where do they live? I think he said he lives in California or something like that. I think he moved to Hawaii, I think is what the goal is. So he's like, look, or should I move to a less expensive state? All right, so let's look at that. So, okay, good. So the spouse, Mrs. M, has nothing in her name. So that's a issue right there when it comes to estate planning. So let's just take a gander real quick. Have they done any? Okay, so the first thing we want to make sure is that they have powers of attorney, durable powers of attorney. And this is what we do when we talk to them for sure. Again, we're not going to talk to these people, but the first thing that jumps out at me when I see that kind of balance sheet inequity, if you will, we want an equalization of estates. And if we don't have an equal estate, we certainly want to make sure we get our powers of attorney in place. So that way Mrs. M has access to this amount of money in his IRA just through a durable power of attorney. All right. He was 62 and she's 58. So let's just go to their profile and see what they got here. All right. So profile. All right. See what his investment is. Traditional IRA. He's got, the Wellington Fund. There you go. All right. Wellington Fund. Right on. Okay, cool. So he's keeping it simple. I like that. 30,000 in money market, 1.3 million in Wellington, and 30,000 S&P 500. That works for me. Let's just take a look to see how the breakdown is. There you go. 65, 35 roughly. And we're going to get, I'm projecting a 5.5% annual rate of return going forward with a pretty high standard deviation. So it's interesting there. Good fund. Obviously, you know how much I love the Wellington. But we're certainly not swinging for the fences here by a stretch. Okay, cool. And it should be all in IRA. Yeah, it's all in IRA. Okay, so tax allocation is 100% in IRA. All right, so let's go back to profile. Real quick, guys, I just delete the credit card stuff anyway, so don't put credit card stuff in here just because I'm just going to delete it. The reason for that is because a lot of people pay off their credit card on a monthly basis, but it says what's your minimum monthly payment. And if you say $300, even though you pay it off on a monthly basis, it's going to take that $300 a month as if you're having that as a cash flow expenditure. So don't do that. I mean, if you have loans, that's fine that you're not paying off on a month-to-month basis. But just generally the credit card, don't put in there. All right, so let's see the property. $875,000 is the value. 2.5% annual appreciation. All right, that's not much of property tax. Or maybe they do live in Hawaii. I can't remember, but that's a very low property tax. I think they did live in Hawaii. Now I think about it. $1,800 in annual insurance. That ain't bad, man. That ain't bad at all. Because Hawaii is cheap when it comes to property tax. Take a look at the loan. Paying about $2,000 a month. Okay, so I guess this assumes he's moving to Hawaii. Okay, gotcha. So he's leaving, California, moving to Hawaii. So he's going to buy this house in Hawaii that's going to be worth $875,000. And he's going to have a mortgage of basically half that, roughly. A little bit less than half. So that's good. Okay, cool. I got it. So it's $2,000 a month for that $875,000 house. Fixed rate, 3 7/8, and it'll be a 30-year term. Okay, cool. Gotcha. So, all right, let's take a look. That makes sense to me. I don't know if he's got anything in here for insurance. He's got group life insurance. Okay, good. Yeah, nothing there. Anything else there? All right, so this is basic. All right, pretty basic stuff. So good job, Mr. Self. Let's see the goals here. So he wants to retire when he's 64, but he's 62 now. All right, let's take a look. So, all right, let's just, so I guess he'll work in Hawaii for a couple of years and then he'll hang up his boots. Okay. Um, Nothing for healthcare costs. Why? Why? He's got Cobra. All right, he's got Cobra there. All right, anyway, retirement expenses 4,700, and remember that should not include the mortgage. I don't think he did. I like how he zeroed out long-term care costs. I think that makes sense. Annual retirement healthcare costs is zero. Travel budget $9,000. He'll have that. Let's just make that joint. He'll have that until he's 2034. Okay, cool, good. Cobra 1 year for self and spouse. For 1 year, Cobra $7,200. That seems a little bit on the low end to me. Oh, Cobra, no, not Cobra. Spouse medical 9,000 from 2022 to 2025. All right, but then what happens after that? So we're gonna have to add probably a healthcare expense. Let's see. No, okay, yeah. So we don't have that. All right, so we're gonna have to add a healthcare expense for when they go on Medicare. Spouse medical. Yeah, okay, cool. So in 2026, we'll have to add for her, and then for him when he goes on Medicare, which I think is in 2022. Okay, so we'll do that. Income. Makes pretty good money at work. Looks like she does not. They got, all right, good, man. This guy did a good job. A Roth conversion, 25,000. Let's just zero that out for the time being, and we'll just get a gauge of where we're looking at without the Roth conversions, but we can come back to that. All right, Social Security. All right, cool. Full retirement age, 2816. All right, good. And he wants to take at 70. And she'll get it at her spousal benefit at 67. Okay, cool. So she'll get a spousal benefit at 67. Good. All right, savings won't really matter because okay, cool. So all right, that's interesting. So now let's go into. I just want to always look at the tax thing. Let's see what that looks like first. That's not bad, man. Now you got that big widow's tax trap right there. Oof. Jumps from 11.4 to the feds, 2.6 to the state, to freaking 17 to the feds, and 3.8 to the state. All right, so let's do an initial. First, we're not going to see. I don't care about. We got 81% at this stage. I don't care. I want to see the cash flows because I just want to make sure. All right, so he's going to work through the end of 2020. All right, that looks good. 2021, he won't work, so he's going to have Cobra here. Then he's going to have. Let me write that down. And then at 2022, we need long-term care for him, LTC for Mr. in 2022, or Medicare, and then 2026 for Mrs. All right, cool. All right, good. Income flows when they both go on Social Security, right there, 75,000. Okay, that's good. Plan distribution, that's the RMDs right there. So you can see some pretty significant, they have no income from 64 until Social Security kicks in. They got no income whatsoever. So they're pretty big net outflows in those 3 years. 1, 2, 3, 4, 5, 6, 7 years. They're going to have pretty significant net outflows. And it's going to have to come from their IRA, which is not a bad thing necessarily. I wouldn't add Roth conversions in that case. I guess you might. Well, we'll see. But then after that, they're going to have positive cash flows. Again, I'm looking over here. Come when he's 70, they'll have $1,000 of positive cash flows. Then it just goes up because the RMDs are just huge. And then she dies, then he dies. So their income goes from, dude, I hate the widow's tax trap. Income goes from 222 to 192. It drops $30,000, and yet, so the income drops by 15%, and the taxes goes from 30,000 to 40,000. Income drops by 15, the taxes increase by 33. That's freaking nuts, dude. That's nuts. Yeah. All right, that looks good though. So let's just take a look at income flows, Social Security, no pension. Okay, cool. That looks good to me. So Social Security, he'll have it at 70. Then she'll take her spousal benefit at full. She'll get her full benefit there at 67. Good job, man. Good job. You know who you are, my friend. That's pretty good. Then he dies. She loses her benefit, but will get his instead. Okay, that looks good. Other inflows, there shouldn't be any. Yep. Okay. Expenses. And that's that mortgage, because they're going to carry that mortgage at $2,000 a month plus property taxes and plus homeowners insurance. Yeah, what if they didn't have the mortgage? All right, so they're going to, they're going to have six figures no matter what. Huh. Let's do one of, I want to run a number, see what they just paid off that mortgage, one fell swoop. Let's see how that works. But you can see they're going to have six figures, essentially, expenses, essentially for the rest of their life, because they got that mortgage in there. Not spending a huge amount of money. And don't forget, they have other expense right here. Where is it? Other expense, financial goals. Yeah, vacation. So they got these pretty big, elaborate vacations. No, we got to add another expense. So that's right. So we got to add the Medicare. So let's go back to add the Medicare. We got to go to profile. We got to go to goals, and we're going to add, is it here, or is it actually expenses? Yeah, right here, medical. And we're going to add, so she needs from 2020, Mr. Medicare, 2022 and beyond. Start. And we're going to say it's $400 a month for $5,000 a year. Health inflation, good. So that'll start in 2022, and that will end at his death. Okay, cool. End of plan. Yep, there you go. And we got to do the same thing. Let me just pause this real quick. We just added Medicare for both those guys. So let's go up to retirement, and see how that, it was 81%. I imagine it's going to be a lot lower than that. Yeah, 50%. Okay. So that one expense right there changed things around quite a bit. Yeah, here's their healthcare. Okay. So yeah, there it is. All right. So basically, and we're inflating healthcare by 5% again, as I say all the time. We're inflating healthcare by 5%. So what's that's not cheap, man. That's Medicare, right? And again, we're doing Part B, Part D, and we're using a Medigap or Medicare supplemental policy, not a Medicare Advantage. So that's a challenge here. No other way around that. So the big living expense plus housing plus healthcare, and then they got their vacation. Where's it? Financial goals. That's a big deal. So let's go back to analysis. This I don't like that 50% success rate. So let's click action items down here. What if we let's see, he's a moderate. What if he did aggressive investor? Would that change much? Yeah. Ooh, okay. So aggressive investor doesn't change much. Yeah. So it's not the investments that they have. It's the cash flow. Okay. Click on this guy. Let's just go ahead and. Yeah, it's not going to work. So let's take a look at confidence. Yeah, that's not good. So the median when they're 81 is they have $668,000. That in of itself doesn't concern me, but you can see it's just dropping, and then yes, that's getting to be kind of problematic. 25% chance of having no money or more, so that's a little bit too much. So what if we drop this down to, let's say, $4,000 a month instead of $4,700? So that's $700 less a month. That's $8,400 a year. Let's just take a gander, shall we? What will that do? That changes it back to 81%. As long as we're above 75%, I'm pretty comfortable with that. So we can see, yeah, look at that. Here the median and the 20. Basically, see that dark blue? You got the dark blue vein. That's the median, 50% above, 50% below. And then the 25 to 75. I'm pretty comfortable with that. The 25 to 75. Essentially, that's you got 25%. Or more, you had at least 500,000 or more. So 75% of the time, you had at least 500,000 or more. There is some chance you ran out of money, but the 75% of the time you had pretty good money, that's for sure. And that's without tightening your belt or anything. Let me show you what I'm talking about. If we go to cash flows, expenses, this again, the thing about this, it assumes that you're going to increase your expenses each year with inflation. So here's 2027, Mr's spending $70,000 a year. Here's 2037, spending $93,000 a year. Mr. and Mrs. Self. Here's 2047, spending $125,000 a year, and that's when the mortgage goes away. So not the mortgage goes away right the last 2 years. So yeah, we don't want to leave Mrs. with a mortgage, that's for sure. So that's interesting. Yeah, so we can reduce the expenses like I just did, but that essentially is their vacation money. We don't want to do that. So let's go back to 4,700. 4,700 a month retirement monthly expenses. So let's just say we'll split the difference. 4,250. Let's see what that looks like. 71%. Yeah, still rather have over 75. Okay, so let's see here. Interesting. What if he works for one more year? Yeah, that doesn't change much. That is weird. Working one more year, it actually reduces his probability. Why? Because he must be spending a lot. Yeah, pre-retirement living expenses. Yep. And then they got that watch. So pre-retirement living, watch this. So if he works another year, go to cash flows, go to proposed. Did it work? Not take. All right, let me see why it didn't take. Why is it not taking? Hold on just a second. I just had to change a couple things, but now I have them working through 2020 and 2021, and let's see what that looks like here. Yeah, still doesn't. I mean, it changes it a little bit, but not much. This was travel expenditures, man. There's no other way around that. Expenses, they do drop, but see, they still stay pretty high while they're working. Goal, oh wait, maybe we gotta get rid of that goal. Hold on just a second, profile, because that's a travel goal in 2000. Yeah, medical. We got pushes back 1 year to 2022 and 2022. Crack how? There we go. All right, so that will change that. Did I hit save? Yeah, there we go. Okay. Okay, good. That looks good. 2022 for spouse. That should be 2022 as well. Okay. All right, so let's take a look now. And this is literally what I do when I do these retirement plans, by the way, folks. You mess around with it. There's no right or wrong answer. Okay, so there it goes. Yeah, that didn't do much. Huh. Because you got these zeros here for no income. I mean, there's still... Look at those RMDs right there. Now, this is on a linear base right here. What you're seeing here is on a linear base at 5.5%. Yeah, it's not going to get the job done. At least, I'm erring on the side of caution here, my friends. So what I mean by that, if we go to analysis, let's just say he gets better than a 5.5%. We can say, okay, what if you go aggressive? I'm not sure how much that will change it. Probably a little bit. No, not at all. Just because you're taking on more risk. What if you go all U.S. total stock? How much will that change it? A little bit. Not worth the risk, in my opinion. So let's just go back to the way it was. All right. So now, what if he reduces his income from 42,700 to 42,50 again? So we're reducing it by, basically $450 a month. See, that's it, man. You're gonna have to. So here we have 4,700, which essentially that includes his travel at $9,000 a month a year. 4,700 minus 4,750 by 4,700 minus 4,250. That's 450 times 12. So that's 5,400. So instead of spending $9,000 on travel, he's only going to spend roughly $5,000. That would do the job. Man, it's a tough one though, because your retirement, it's tough because retirement expenses assumes you're going to be spending that again for the rest of your life. Now with the travel, it doesn't assume that because you've already made it in there about when the travel is going to kick in and when it's going to stop. So that's a tough one. I just got to try something. I got to try paying off this mortgage. Let's go back to net worth, loan, and just taking the tax at one fell swoop. So we'll say, let me hit pause. Hold on just a sec. Let me show you what I did here. Is I paid off that mortgage in 2022 when he stops working, and look at the tax right there. And we're just taking it from the IRA. You can't do that. You can't do that because you're going to pay. I mean, watch. It's nuts. All right, so watch the expenses. The expenses drop because his home housing went from $28,000 to $5,000. But it cost $420,000 to pay off that mortgage, and then looks what happens here. Watch the accounts. To pay off that mortgage, he's gonna have to pay. He's gonna have to take out $727,000 of accounts from his IRA. Just you can't do that. Got a phone ringing. Hold on a sec. Let me turn that off. Man, that's tough. All right, so let's do something else. Let's not do that. I'll come back. Actually, I'll figure I'll show you what I'm doing here. Actually, so we're gonna go to net worth. We're gonna go down here to property loan, and we're not gonna have an early payoff. We'll just say no early payoff, and we'll go back to there. All right. So what we're gonna do though, let's go over to retirement researcher and run a. We're gonna do a line of credit on a reverse mortgage. All right, hold on just a second. So I'm at retirementresearcher.com, and you get this pop-up, and you should definitely sign up for Wade's email. You get it every Saturday. So we're going to hit resources, reverse mortgage calculator, calculator, as Richard from Amazing World of Gumball would say. Homes appraised value, I think, what do we say? I just did that, big man. I think we said $800,000, or $875. They can't give you the full amount for that though. But $679. Lender's margin, monthly insurance, age of youngest eligible borrower. So we'll say 65. Youngest, okay. We'll say 60. What should be 63, I think. So when he stops working, I'm kind of going with that. A loaner, okay. So percentage of debt repayment. Okay, so he's got, how much do you have on his loan? 425. Debt repayment 425. All right. 425.0. There we go. Doesn't have enough. He's got 679 is the max he could use. So the max they could use is what? Let's get rid of that, because remember, you can't do a home equity line, a home equity reverse mortgage, conversion mortgage, unless they're the first. So the first mortgage in this case, Bank of America would have to be paid off for the HECM to work, and the max he can borrow is $287,000. Yeah, it's not going to work. It's not gonna work, man. This mortgage right here. The mortgage is always the bugaboo. Always the bugaboo. Well, what if he did a SPIA? That might be a good choice. How much would a SPIA generate? So let's go to incomeannuities.com. Hold on. Let's see about that. So I went to income annuities, and it took me to some weird website. So I ended up at Schwab. They have an income annuity estimator. So let's take a look here. I like Schwab, by the way. We're going to do month needed. We need $2,000 a month. Income start date, we'll say 2020. We'll say August 1st. And his date of birth was 0101. He was 64 years old, so 2019 minus 64, 1955. 1955. He's a male, and I think they said Hawaii, if I'm not mistaken, or that's what they're thinking about. Okay, and we want it for joint life. No clue how much this is gonna Okay, looks good. Oh, I guess you gotta do that. Okay. And the female, we'll just say 01, 01, 1958. Let's take a look here. And we need 2,000 a month. Set period of time. Let's just do it for 28. We'll say let's just see what they give us. We're going to do a set period of time. It doesn't tell me where period certain. It might do 20 years. Let's take a look here. So if we put in $363,000, it'd pay us $480,000 for 20-year period certain. If you pass, okay. Yeah, I don't like that. Okay, so that's so we put in 363, we get 480, and there's no amount left over. Okay, that's not what we want. So let's go back to. Can we go back to change a new estimate? And let's go to joint life. Let's see. Oh. Okay, let's see what we got for joint life. So we put 450. Okay. Oh, here we go. 459,000. We have a joint life with 20-year period certain. All right, let me just explain how this works real quick. There's absolutely no reason to do a joint life only because if you both got hit by a car and you're both dead, and then there is no guaranteed minimum payout. If you do a joint life with 20-year period certain, you're going to put 459,000 into your portfolio, but it's going to be paid for 20 years or joint life, whichever is longer. Does that make sense? So, I mean, you're sacrificing. It's cost you $5,000 in total premium to guarantee $480,000. Where the $5,000 in total premium, if you save that, you get a minimum payout of $0 guaranteed. So don't do that. Always do a joint life at 20-year period certain. I'm telling you. All right, that's good. That gives us something to chomp on here. So if we took remember, to do this isn't a lump. It's not a lump sum where you get taxed right out of the gate. So let's do this. We're going to do $459,000. We're going to take that from their IRA. All right, so we're going back 459. We'll say 459,000 for simplicity. Well, 1.39. We're going to take 459,000 out. So let's take a look. So 459 divided by 71.07. That's 6,458 shares. We got reduced minus 18,861. That leaves 12,402 shares. Oh, this guy, man, this might be the way to go. 12,402. That should, yes, oh, man, it's going to be great. All right, so now what we're going to do is we're going to exclude this. All right, so what we're doing here, you see what we're doing? We're saying we're going to take this income annuity, we're going to dump $60,000, whatever, at 459. Into a SPIA, a single premium income annuity. That SPIA isn't a lump sum from a tax perspective. It's paid out over every single month, so you don't get killed with taxes on the front end. You don't, my friends. You don't. You just pay taxes. So every month you get $2,000 a month. So you get $24,000 a year. All that would be taxable as ordinary income, just like a regular IRA distribution. But it removes that amount from RMD in the future. And on top of that, it gives you you know for a fact you're going to have 24. It's a pension. It's no other way than a pension. It's a pension. That seems pretty good to me, man. $2,000 a month on 459, 24 divided by 4. Yeah, that's 5.2. Man, that's not as good. But still, but anyway, for what we're trying to solve, I think this is going to be pretty good. All right, I think. So now this mortgage is paid off. I mean, the mortgage is still there, but they have $2,000 a month coming in every month in which to pay it. Now, the only thing that would change on the mortgage would be the property tax. All right, so the mortgage itself is locked in at 3.875. The property tax will change for sure. So you're going to have to come up with some extra money, but the property tax is minimal, relatively speaking. So let's take a look at what this looks like. I think it's got to increase it, the ability. Oh, yeah. Look at that. Look at that. Yay! We're number one. Take that, Canada. We are number one. If I can get an 80% probability of success and you're living until you're in your 90s, and that means you still have 50% of the time you have $750,000 left over, look at that. Look at that median. That is fantastic. Look at that. 0 to 20, 25 to 75. So 25% or more of the times you have over $168,000 left of liquid assets, not even including your home. You haven't done reverse mortgage. All you've done is a single premium annuity in which to pay off that sucker. Again, it's not being paid off. I grant you that. But it doesn't take away from your ability to go retire, to do the kind of stuff you want. It just takes it out of the market. I mean, let me show you. You still have the cash flow. You're still paying your Medicare. You still have the cash flow in order to go on vacation, whatnot. You know, he's taking goals right there. So he has these vacations. He's still doing that. So what happens if I have him cutting out 1 year early? So he had, is it goals? Goals, yeah. I have him cutting out at 64. Right. And income, oops, we have him cutting out at 64, 2020. Okay. Ooh, that 1 extra year really does a lot. It really does a lot. Yeah, that 1 extra year, man. Yeah. All right, so in this case, our friend Mr. Self really needs to work 2 more years. But then if he were to work 2 more years, he's got an 80% probability of success, which is fine. It's just fine. Again, I'm using a 5.5% rate of return. We're not swinging for the fences, and it could get significantly higher than that. It could get lower. I get it. We're inflating healthcare at 5% a year. We're inflating cost of living at 3% a year, and we're only giving you 2.6% Social Security bump, which those are numbers from the trustees report, by the way. But if I can get 80%, I'm very comfortable with that. Let's just have them again. Oops, current proposed. I need to go back and change profile. Oops. All right, so what I'd recommend to this guy, say, hey, look, man, you got to stay at work for 2 more years. Once you do, you should take by that, I don't know what the single premium income annuities will be at that point, but right now that'll cover your debt without question. And on top of that, don't forget, once the mortgage is paid, and if you guys are still with us, you'll have the extra $2,000 a month to live on. But Josh, inflation, I get that. We're not using it as an income stream. We're using it as a way to pay off the mortgage. But if inflation happens for him from an income stream, it's also going to happen where it makes his mortgage that much less hurtful too, because the mortgage is fixed. So you got a guaranteed income that's going to be taxed much more favorable because it's coming out $24,000 a year. There's no 10% penalty, nothing like that. And on top of it, it's going to cover that mortgage. If inflation hits, they're both going down. If inflation doesn't hit, they're both it's a wash. It's a complete wash. But it allows the other money to be invested still in order to live on. Hard to see huge benefits of Roth conversions here because it's just not getting hammered from a tax perspective anyway. I mean, look at that. Just not a big taxes. At the end of the day, when Mrs. survives him, it'll jump up some, but I just don't see any benefits of Roth. Anyway, a lot going on there. That's the kind of stuff I do, man. This kind of stuff I love doing. It's fun because I think we did solve a dilemma. Hope you find this helpful. Smash! Don't forget to share, and don't be overlooking SPIAs, income annuities. They can play a huge role, especially for those of you who have a mortgage going to retirement, for sure. In this case, he could not take a reverse mortgage. He had too much he owed on it. And too young in order to have that line of credit big enough in which to take out that first anyway. So in this case, it's not happened. So he's got to find another way. And the single premium income annuity did it. All right, we'll see you next time.